click that, continue. Welcome to Java with Jim, or we may change it to, I don't know, brunch with Jim. I don't know. It's a little later in the morning now, but doesn't rhyme as well. So we'll have to come up with something else. Today, we're going to talk about money and, the various flavors of which you could potentially bring money into your company. We're not talking about selling here. All we're really talking about is growth capital of a variety of flavors. And we're going to talk about the different flavors that you could possibly contemplate and why you might want to have each of these kinds of financing come into your company. And having said that this, to Julie's point, this might be the 101 or 201 version. There is a 301 and 401 version, and I'm not doing that today. So the financing is only limited by the creativity of the financier. So you're going to see all variants. But I have to say that most of the variants are elements of what I want to talk about today combined in slightly different ways. So if you get these, you've got the Lego blocks that they use to build the larger structures that you might see. So let's talk about the three elements of sort of cash coming into your business. One is debt. And I'm going to talk about a variety of flavors of debt. And that's certainly one option as you grow your business. It's got pluses and minuses that we're going to talk about. And that sits on the balance sheet as a liability because it's an IOU basically, and then cash offsetting it. Equity is where somebody buys a position in your company. So they own a percentage of your company. It's all cash goes in. There's no liability against it. And there are a lot of reasons to like equity when things get ugly. And I'll talk about that in a little bit. And then there are hybrid models, which I'll also talk about, that are kind of debt, kind of equity, and they have elements of both. And we'll talk about that. So let's start with straight down the middle vanilla debt. And this would be bank debt. And this is where you go to the bank and you go, look, my business is growing. I need capital to continue the growth. Will you loan me money? Now, let's roll back for a second. There are really two reasons to need capital. One reason is capital to fund growth. And that could be capital that is used for things that move over time and things that don't move over time. So things that move over time would be things like accounts receivable. As you grow, your accounts receivable grow, therefore you need cash to finance your customers, basically. You're lending money to your customers in the form of accounts receivable. So you got to get the money from somewhere. If you're growing fast, you've got this incredible cash need. And you go, wait, Jim, if I've got, people that owe me money, then I owe people money and that offsets. Well, yeah, but, normally there's not enough of a spread. The spread is too far for one to pay for the other. You'll always need incremental capital to fund growth. So that's one. Accounts receivable being a big one. Another one would be inventory. If you have inventory in your business, as you grow your business, you might in fact need capital to fund your inventory. That is fundamentally something that moves, hopefully. And then the last one would be maybe equipment and capital. Meaning capital equipment, machines, buildings, stuff that doesn't move. It's long-lived and you're going to need it to continue growing your business. But it's not something that flexes up and down based on how the business is doing. So, and then the third reason why you might want growth is to increase your leverage. Now, I've talked before about private equity companies and how they put debt on businesses to increase their cash-on-cash returns. The same thing's true for you. In fact, there is an optimal capital structure for your business that includes debt. Zero debt is the low lever model, which means the lowest rate of return that you can have. A little bit of debt will increase your cash on cash, your cash on return on assets. But there's a limit. You don't want to have too much. So it's that sort of Goldilocks position of some debt to get me leverage and improve my return, but not so much debt that I'm get in trouble if things go bad. And I'm going to talk about that in a little bit. So the first option is go to the bank and you get a vanilla loan. Now, the easy one, if your position, is an SBA loan. This is desirable because it's got better terms than a normal bank debt. Why? Because the government is basically backstopping the bank. They go, hey, the government is saying, we think it's really important for you to loan money to small businesses and grow them and medium-sized businesses. And so we will take some of the risk off your table if they don't pay you back. Consequently, the bank doesn't need as high a rate of interest, and they don't need as much security for those kinds of loans because they got the government backstopping you. 7A is probably the plan you're going to look at. It'll go up to $5 million, and it can be used for all the things I just talked about: working capital, inventory, equipment. There's another one that's a little more focused exclusively on capital assets like buildings and real estate, and that's called 504. Again, $5 million limit. But you get about $5 million on an SBA loan, and generally they don't require a personal guarantee. So let's just talk for a second about personal guarantees. For those who were on last year with Ami, he is sort of a fixer. He can help you find an SBA loan. So if you want to hit the easy button and get an SBA loan, call Ami. We can hook you up with him. And Sharon, if you could pull up the name of his company and maybe put it in the link. Ami Kassar, Kassar. He can help find it for you for like 1% of value. So you don't have to go find it. Like, I'll give you an example. I tried to go talk about to my bank, my primary bank, about an SBA loan, and they said, yeah, we're not doing them right now. So I got to go find another bank that I don't have a relationship with. I probably just hit the easy button and use Ami and say, you go help me find somebody who'll do an SBA loan for me. Lots of banks do them. Lots of banks specialize in them. My particular bank doesn't. So let's talk about personal guarantees. This is one of the big deltas between an SBA loan and a non-SBA loan. When you go for a relatively unsecured loan, and generally they'll do it on multiples of cash flow. Now, they'd love to have security, like, if you don't pay us, we take your building. If you don't pay us, we take your inventory, which they don't like much. But let's say they just do it on cash flow. They'll say, look, you're making $1 million a year. We'll loan you $2 million against that. That's a pretty typical loan, okay? Generally, a bank will require you to do business with them if you're going to get a loan from them. We want to see all your cash moving in and out of the account. They will also require covenants, which I'll talk about in a minute. But the big thing they're going to require, particularly at the size of most of these people on the call, is a personal guarantee, which is to say, if you don't pay, yeah, we loaned it on your cash flow. We like the business, but if you don't pay us, we're coming after you personally.
Yep.
We're going to take your house. We're going to take your bicycles. We're going to take your kids. We're going to take your cars. We're going to take everything. Which has a way of clarifying an entrepreneur to make sure the bank gets paid back, right? When you're on a PG like that. Now, I'll tell you that the reality of how many times I've seen a bank go after somebody on a personal guarantee, zero. Never, ever have gone after anybody on a personal guarantee. They really don't want to be the guys and gals that take people's houses. They have the right. They use it to clarify your thinking. They will rarely ever execute on that. Now, one of you will go get a deal, a loan, give a PG, the loan will fail, and they'll take your house, and you'll say, hey, Jim, I thought you told me that wasn't going to happen. I'm like, I'm not promising you. I'm just saying I've never seen it, okay? So just to be clear, it's not a guarantee here. But personal guarantees are really a struggle. And what's crazy about this is, you know, we've got one CEO we work with that has a $5 million personal guarantee on some of the loans that he's got from a bank. And I don't think the guy has $1 million of personal net worth. Like, how does that work that he guarantees $5 million and he only has $1 million he could ever give you if he gave you every nickel he had? So it's a little weird. And again, it isn't about recovery for them. It's about, multi-funding. Perfect. Thank you. It's about keeping you focused. So let's go to covenants for a minute, because that's going to be a really important point and an important point of negotiation when you start talking to the bank. They're gonna, if you do it on a cash flow basis, so they're willing to loan you an amount based on the multiple of cash flow, no security, in other words, they're gonna say, yeah, that's all good, but we need to make sure you stay healthy so you can pay us back. And what they'll implement are called covenants. And these covenants require that your financial performance is above a certain level, generally represented as a percentage of what they loaned you, or as a percentage of how much you owe them every year. So One model might be cash flow. So in my example, I did a 2, right? It was a 2 times multiple. We loaned you $2 million on $1 million of earnings, of cash flow. And so they would do something like, you need to keep your ratio of debt to cash flow below 2. Am I doing that the right direction? Debt to cash flow below 2, meaning you got more cash flow than you need to pay us back, right? Another one they might say is a coverage ratio, which is the interest only on the payment on the note that we have to you. You can cover that by a factor of, let's say, 3 or 4. And if you get into trouble, your business cycles, right, and you go below, you break those covenants, they have the right to reprice your loan and sometimes charge you penalty as well. And you go, well, what kind of sense does that make, Jim, that I'm in trouble and they want more interest and they hit me with penalties on top of it? Welcome to bankers. All they care about is getting their money back. And so you've become more risky. And when you think about risk and return, they go, hey, that deal just got riskier because they violated the covenants. Therefore, we need a greater rate of return to loan to that person, right? So that's how they think about it. They are not your friend when things go down. And so when I think about bank debt, I would think about structural debt that won't change over time. If I have a non-cyclical business, you can have plenty of that. If you have a cyclical business, I'd have a layer of this, like a layer cake that was not very big. In other words, my minimum projected performance with all the cyclicality in my business, seasonal and whatever else, I won't break into the covenants on the amount of debt I take down. And by the way, covenants are negotiable. They'll go, oh, this is easy. You borrowed 2 times, we'll put the covenant at 1.5. And you might go, no. We're going to put the covenant at 3 times. Make it favorable to yourself. They're going to try to snuggle it up against what they loaned you. You can negotiate this to be more advantageous to give you some buffer. So covenants are negotiable, 100%. Make sure that if you ever go get bank debt, you negotiate your covenants because they will be the thing to come back and bite you in the tush, okay? The other element that you can get from a bank is what they call an ABL. It's an asset-based line. Now, asset-based lines are secured. So the interest rate is lower. And because if things go south, they can go claim the asset that secures the loan. It's asset-based. And normally, they'll only lend a percentage of the value of the asset. So for example, you get an asset-based line on your inventory. They might only be willing to pay 60 cents. They don't only loan you 60 cents on the dollar on your inventory. You got $1 million of inventory, they'll loan you $600,000 on it if they think it's marketable. Like if everything went to hell and they had to just go take the inventory and sell it, fire sale on the market, they'd be able to get their 60 cents out. So that's how they think about it. How much could I get if things went horribly, horribly bad and I had just dump it? Because they're not going to do an organized sale. They're just going to dump it. The other thing they'll lend against is your receivables. So if you have quality clients that take a little bit of time to pay you, government, let's say the government's your client, that's a pretty good client, but they take their sweet time paying you. For any of you that do business with the government, 60 days is not atypical, 90 sometimes. And you could go to the bank and say, look, I've got $1 million invoice to Social Security. They're a known good payer. I want you to loan me 70 cents on the dollar on this invoice. And they will happily do that. Okay. They won't do 100%, but they'll do a healthy percentage on a known good. If it's a little more dodgy client, they're going to go lower percentages, right? Because they're not sure that you'll collect the money. They also will not count any international business. So anybody that does business outside of the US, and Canada is counted as outside the US, unfortunately, as is Mexico, as is Caribbean, they don't count that. They will not count that in your accounts receivable. So we've had some clients that had, 30, 40% of the business international, and they went to get an ABL, an asset-based line, and the bank goes, great. That 40% that's going to, Mitsui in Japan, which is a multi-billion-dollar company, we don't count that. Doesn't count. It's Japanese. We don't understand it. but that 60% of business in the US will give you 60% on that. So they end up only loaning you 36% on your total receivables, which is kind of a kick in the pants. But it is very hard to get factoring or ABLs on your receivables outside the US. Very, very hard, almost impossible. I've never been able to do it. Supposedly the Ex-Im Bank will do it, but they're like the only one. So structural debt, asset-based lines, those are the two. And I think you really have to look hard at your seasonality and cyclicality of the business when you think about what's the right debt structure for you, right? If you are in oil and gas or in technology or in anything, let's say you're in things, the direct-to-consumer, where Q4 is the Christmas season, is always the biggest season, highly, highly seasonal. You want to keep that debt level at your Q1, Q2 numbers, not your Q4 numbers, right? And you let the ABL float up, right, during the busy period and then float back down when you get out of the busy period. So that's a perfect use of structural debt and an ABL sitting on top of it to deal with your cyclicality. So Bruce, you probably have a big Q4. You would want to use an asset-based line for your Q4 sort of cycle. Now, I think your credit card, so you don't need to worry about this, but suppose you extended credit, you'd be thinking like this. And there are third parties that will do factoring. There are factoring companies. They tend to be at higher interest rates than banks. But if you can't get a bank debt, you can go to a factoring company. And the math can work on that as well. There are reputable factoring companies out there. There's another tier of debt that's available that's structural if you really want to lever up your company. And sometimes you have to do this. Let's say you did a big acquisition and you really stretched into it. So you put some bank debt in to cover the acquisition, and you put your capital in, and you don't quite have enough to bridge the whole gap. There is a category called mezzanine debt that you can think about there. And these are not provided by traditional banks. These are provided by private lenders. And there are funds that are mezzanine debt funds. That's what they do. And the idea of mezzanine is, when you think about the debt stack, first are the secured creditors, right? Then might come the bank debt, and then might come the unsecured creditors. So they're kind of risky, right? If things really go bad, they're like third in line to a whole bunch of other people, including the employees are actually first in a bankruptcy. Employees, then secured, then unsecured. And these guys might be third, right? So they have no security. So their interest rate's going to be high. So traditional bank debt we're seeing right now, because interest rates are just stupid low, 5, 6, 7%, depending on how risky you are. Mezz debt will go 12 to 20. So you got to be sure you need mezzanine debt before you go get it, right? Because it's going to be double the cost of your bank debt or even your ABL, which it might be a little bit higher. It might be 8 or 9. So available, again, it will have covenants on it. And these are the really risky ones, because if you're pushing your debt levels high like that, any little miss in your numbers, you're going to violate covenants. And anybody who's been in covenant violation, and I have been, I'll tell you, it is a very, very unhappy place to be. Has anybody ever read the book Man in Full by Thomas Wolfe? You read it? It's a book. This is a guy who wrote Electric Kool-Aid Acid Test, and famous author. Anyway, Bonfire of the Vanities. He wrote a book about a real estate developer in Atlanta. And he's a man in full, right? And he's beautiful wife, big house, beautiful kids, big car, doing big projects. He goes up to the 38th floor of this gorgeous bank building. They got mahogany and leather and crystal glasses for the drinks, and as they're loaning him money. Then things go sideways, and he starts breaking covenant, can't make his payments. Well, the next meeting, they call him into the bank, and he goes, meet you on the 8th floor? Nope, in the basement. He goes in the basement. It's plastic tables. One leg is shorter than the other, so he's rocking in the chair. It's cinder block walls. There's no windows. He goes, hey, where'd my relationship guy go? We go, he's not around anymore. You're dealing with me now. And these are the workout guys, and they are there for one purpose: to extract the maximum dollars they can of the dollars they lended you, and they don't care. They don't care. They don't care. They don't care. So it's all, you know, I laugh when people say, I've got a great relationship with my bank. They'll lend me all the money I want. I go, sure they will. Break one covenant and see who's in front of you the next time. It won't be Mr. Friendly Banker. It's going to be somebody else. So you don't want to break the covenants. It's a bad thing to do. But sometimes you have to lever up, and hopefully you've got a plan to lever down through earnings as quickly as you can. All right. There are another class, and I won't recommend doing business with these people, but there is another class of sort of rapid advance type players where they will lend you money in a day or two. And what they generally are looking, they would be willing to lend Bruce money, for example. They look at your credit card flow, and they're focused on unbankable companies mostly, which most of you don't fall in that category. And they go, here's the deal. We're going to lend you $40,000. You got to pay us back $80,000. And what we're going to do is we're going to put a new credit card system in, and every credit card swipe you take, we're going to take 10% of it to pay down your loan. And we've projected that over, 12 months or so, you'll pay down the $80,000 you owe us, right? Now, some of you might be going, hey, wait a minute. They loaned me 40 and they're getting back 80 and it's 1 year to pay it back. Holy moly, that's a gigantic interest rate. Yes, it is. But the way they structure it to avoid the usury laws, because there are laws about how much you can charge for interest, it's not structured as a loan. The way it is you just owe us a number. There's no interest rate. There's no nothing. We gave you money. You give us money back. And the time frame is fungible. If it takes 12 months, great. If it takes 18 months, fine. That's all their risk. They go, that's my risk. And I go, well, even if it took me 2 years to pay back, it's still a stupid good return. What are you talking about? So there are people that use these organizations. They exist. You'll see ads for them. I would avoid them unless it is a last resort option for anybody. All right. By the way, on the leverage thing, just a quick example on leverage, like why would you put debt on a business to lever it up? I talked about return, but there's a tax advantage too here. So let's say I had a business where I loaded enough debt that it consumed all the earnings, which you can't really do, but let's say you could do it. And I drive all of that money into growth, right? So no earnings, no taxes, right? Because the interest is deductible. So I have no earnings, no taxes. And then later, and I've driven all the money into growth to increase the size of the company. So later when I sell it, I get capital gains, which at the moment you pay at 20%. So I took all the taxes from income at, depending on what your number is, 40 plus, down to 20 by using debt, right? And I'll be able to grow faster. So that is one of the reasons beyond the leverage reason why people use debt to reduce their taxes and move it over to capital gains. So people don't think about that, but that's a true one. All right. If you have a bank, you're going to have to report quarterly. You're going to have nice, tidy financials. You have to sit down with them every so often and tell them how your business is doing. The good news is they're not on your board. They won't be on your board because that would conflict them. But you will have to answer to them. So you now have a partner in the business, even though it's debt, right? All right. Just for, let me give you one last element. There is an option to go to friends and family, right? So you say, look, I need $100 or $200 or $300,000. I got a rich uncle. I can borrow the money from my rich uncle. All good. And you will be able to offer your rich uncle an interest rate that's very attractive to you, but there are lower limits on how much you can charge for interest. And they're called the applicable fund rates, AFR. You can look it up. And at the moment, the applicable fund rate for a short-term loan is 0.2% interest. You can charge as low as 0.2% interest for an in and out loan. Middle term, 1%, long-term, 2%. So you can borrow from friends and family super cheap if you can get it and not violate the law. Okay, so that is an option. All right. Anything, that's sort of my stopping point on debt. Questions, comments, thoughts? Anybody trying to raise some money or